Everyone wishes they could buy a stock and have it produce exponential profits. We've all heard of someone who bought Apple stock when it first went public or someone who bought Coca-Cola shares before the price skyrocketed. In many situations, early investments in successful enterprises like these would be enough to retire on. How can you even begin to choose a decent investment on your own rather than relying on other stock tips? Investors refer to the 4 M's as the 4 essential points to look for when a company achieves all 4 of the criteria. The odds of it becoming profitable are substantially higher. These are the 4 most crucial qualities of a company to examine before buying stock in it. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. It is critical that a business has a purpose for you, which means you want to acquire a business rather than just a stock. Sure, you could buy a stock to earn quick cash, but you want to own a company that you know well enough to own 100% of. You want to feel comfortable owning the company in perpetuity, even if your entire family relies on it. You want to be proud of your possessions and perceive your money as a vote for the company and what they stand for. Being proud of that firm, their motivations, and what they're accomplishing will turn you into an interested shareholder who cares enough about their financial health to affect your wallet. You are also inclined to use the company's products or services if the company means something to you. Customers who use a company's products and services have practically insider information. Moat. A moat is obviously water surrounding a castle to protect it, but in terms of investing, a moat is a competitive advantage that a company has to protect itself from competitors. When you buy a stake in a company, you want to know whether its future success is predicted rather than just assuming it will be because it has been a good investment in the past. Is it likely that it will continue to be lucrative in the future? That may be the case, but it is not always the case. There are 5 main sorts of moats that increase the likelihood of future and ongoing success. Customers are prepared to spend more if a company has a brand moat, which suggests they trust it. Disney, McDonald's, Pepsi, Nike, and Coke are examples of these brands. If you walk into a store and had the option of buying Coke or a less expensive generic brand, most people will choose Coke. Even if the recipe is identical, consumers are familiar with the brand and are willing to pay extra for it. Coke never has to be concerned about its customers selecting something else. These businesses can also boost their pricing in line with inflation because individuals don't necessarily worry about price. Secret. This is a company that has a patent or trade secret that makes competition difficult, if not illegal. Pfizer or 3M have a secret moat because they have patents, legal protection, or secret manufacturing processes. 3M has over 100,000 product patents, so even if a competitor could legally reproduce a product, they couldn't. These patents provide 3M with a significant competitive advantage. Intel has a large moat as well because they've been developing chips for so long. The only way to gain their knowledge is to hire their personnel. Toll. A company that has complete control over a market can charge a toll to anyone who requires that product or service. In the same manner that you pay a road toll to get to your destination, you must pay to reach where or what you desire. PG&E is a prime example of this. It is the sole utility business in California that offers power to that area. To obtain power in that area, you must either purchase it from PG&E or generate your own. Google has a toll mode because you must pay their advertising costs, or toll, in order to promote in their space. Switching. This mode is used by a corporation that is ingrained in your daily life. It would be extremely inconvenient to stop using their products or services. Apple, for example, has this type of mode. A typical Apple customer owns an iPhone, a Mac, and possibly an iPad. They understand how these products and operating systems function, and they all work well together. As a result, their clients are incredibly loyal. It would be tough to learn how to use another company's goods, and it would be highly expensive to replace your phone, computer, and tablet. Price is the final type of mode. Some firms are so huge and well-established that it is difficult for smaller competitors to compete on pricing. Walmart, Costco, and Home Depot are all major companies in their own markets, and competing with them would be extremely difficult. When these huge box stores buy in bulk, they get better prices, and some of the savings are passed on to the customer. Furthermore, these retailers understand that customers will purchase many more goods when shopping. People like to gripe about how Home Depot is causing problems for their local hardware store, yet they will continue to purchase there because the prices are lower. Management is an essential component of any organization. Who manages the corporation has the power to make or break the enterprise. You should look for traits such as having a plan for future progress and accepting responsibility for past shortcomings. Management who takes modest compensation and owns a substantial number of business stock is a better bet than a CEO who takes a huge income and regularly sells a large amount of their shares. Founders are usually good managers. People like Warren Buffett, Bill Gates, and Jeff Bezos. These CEOs have their entire lives invested in the company and will not want to see it fail. Finally, you must select a wonderful price at which you can purchase the shares. The margin of safety is the difference between the predicted profit and the break-even point. Paying whatever the stock is trading for is a bad idea. Sometimes the pricing is amazing, allowing investors to buy a terrific company at a wonderful price. At times, the market is trading at exorbitant levels that defy logic in light of its fundamentals. Determining which price values a stock at full value and which price leaves a margin of safety takes practice and knowledge of fundamental research. Simply put, don't buy a stock that appears to be selling at full price. Instead, aim for a 50% discount to offer an adequate cushion. A company's CEO may be replaced. A competitor could gain market share. Even if it has a well-established moat, the company may face legal difficulty, or demand for its products or services may falter for other reasons. We've all heard of Blockbuster, Toys R Us, Borders, and Sears. There were moments when no one anticipated these businesses to fail. There are numerous reasons why a company can go bankrupt or perform poorly than predicted, which is why it's vital to acquire at a bargain. When you've correctly screened a stock for the 4 M's, your chances of buying the next Apple or Coca-Cola are significantly higher. Even if you aren't as fortunate, you can still make a significant profit by following these guidelines. Buying firms that do not fulfill these requirements is akin to throwing darts, and it is not a good method to make money in the stock market. Instead of naively purchasing a stock that has been recommended to you, investigate the firm to see if it is a good investment. Is the firm meaningful, has a moat, has outstanding management, and can you buy it at a discount? If you answered no to any of those questions, don't buy. Trust the process and avoid making impulse purchases. These 4 M's are well known in the investing world, and many successful investors employ them. So make sure to take advantage of them. You'd be better off placing all of that money into a wide market fund without performing any investigation. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?